Welcome to Info Sounds by InfoDrip, your go-to source for insightful discussions and explorations. Each week, we break down complex ideas into clear, engaging conversations designed to inform and inspire.
You might have seen some recent chatter about tariffs and how countries are navigating the choppy waters of global trade.
hmm
Well, you've tuned into the right place because today we're plunging headfirst into the world of tariffs, trade deficits, and their very real consequences.
Definitely.
What's got us so revved up about this? We've been digging into a fascinating sketch review from InfoDrip, dated April 3rd, 2025, called Tariffs and Trade Deficits: Misconceptions, Consequences, and Global Adaptations.
And what's fascinating right off the bat, and something the InfoDrip review really unpacks, is the, well, rather unconventional way the previous U.S. administration approached calculating tariffs. It wasn't your standard playbook, was it?
Not at all. Okay, let's get our heads around this. The idea of reciprocal tariffs was floating around, but the calculation was, let's just say, creative.
hmm
Instead of looking at the actual tariff rates other countries were charging, they were zeroing in on the trade deficit. For instance, the review highlights this assertion that China had a whopping 67% tariff on U.S. goods.
Right. Which wasn't real.
Exactly. Now, that wasn't the real tariff rate. That number was apparently cooked up by looking at the U.S.-China trade deficit as a percentage of imports, and then, get this, slicing it in half to get to some kind of discounted tariff rate.
Which, as the InfoDrip review astutely points out, immediately set off alarm bells for economists. What really jumps out is the stark lack of economic nuance. It's a very simplified, almost rudimentary way of looking at something as intricate as international trade.
Exactly. The big red flag that the review waves is this oversimplification of trade deficits. It makes it crystal clear that a trade deficit isn't always the economic boogeyman.
Right.
Sometimes, and this might surprise you, it can actually signal a healthy domestic economy with strong consumer demand pulling in goods from overseas.
Yeah, if we connect this to the bigger picture, and this is crucial for you to keep in mind, trade deficits are the result of a whole complex dance of factors, everything from how much people are buying to where investments are flowing and, the natural advantages some countries have in producing certain things. So just pitting a trade deficit on unfair practices is often a massive overreach.
Which brings us to a really fundamental question, doesn't it? You might be sitting there wondering why trade deficits even exist in the first place. It's not always a case of one country winning and another losing in some global economic game.
That's right. For a large economy like the U.S., the InfoDrip review emphasizes that consistent trade deficits can be a natural consequence of its sheer size, the powerful spending of its consumers, and, well, a significant reliance on imports to satisfy both household needs and industrial production.
And to really paint a picture of how intricate these relationships are, the review gives us a continent-by-continent snapshot of U.S. trade balances. It's definitely not a one-size-fits-all situation.
Precisely. Let's zoom in on some of these key economic relationships. When we look at Asia, particularly China, we see the biggest deficit over $270 billion. Now, this isn't just a number. It really underscores our dependence on China for a vast range of electronics, machinery, and everyday consumer goods. Meanwhile, our exports to China, while significant, just don't match up. This highlights a key area where disruptions could have a ripple effect in the U.S.
Then, if you pivot to Europe, and specifically Germany, there's also a considerable deficit, around $76 billion.
And this largely reflects the strength of German manufacturing, especially in high-value items like automobiles and industrial equipment, which are, in demand here in the U.S.
Okay.
Now, shifting our gaze to Africa, the picture changes quite a bit. With South Africa, the U.S. has a much smaller deficit in the ballpark of $7.9 billion.
Much smaller, yeah.
Here, the dynamic is more about the U.S. importing specific raw materials like minerals and metals, while exporting things like machinery and agricultural products.
And it gets even more diverse. In South America, when we look at Brazil, the U.S. actually runs a trade surplus.
Right. Brazil exports a lot of agricultural products and raw materials that we need, while we sell them things like machinery and chemicals.
Interesting. Moving over to Oceania and Australia, we see another U.S. trade surplus.
Yeah. Australia imports a good chunk of U.S.-made goods and technology, while their exports to the U.S. are mainly in the realm of raw materials.
Finally, back to North America, with Mexico, we see a substantial deficit again, around $157 billion.
This is fueled by our imports of things like cars, electronics, and agricultural products coming across the border.
Right.
So as you can see, it's not a simple case of the U.S. consistently buying more than it sells to every corner of the globe. And as the InfoDrip review stresses, that overall U.S. trade deficit can really be interpreted, at least in part, as a sign of strong demand and investment within the U.S. economy.
Okay.
While concerns about competition are valid, it also points to a robust consumer market.
Okay, so we're getting a handle on the fact that trade deficits are complex and not inherently negative. But the go-to suggestion you often hear for tackling these imbalances is tariffs, right? It's a pretty common notion.
Yeah. It is. And the InfoDrip review lays out some of the potential upsides that tariff proponents often tout. One key argument is that by making imported goods pricier, tariffs could nudge consumers towards buying domestically produced goods, giving a boost to local industries.
Right, supporting local jobs and stuff.
Exactly. Another potential plus in the tariff playbook is the idea that by making imports less appealing, a country could theoretically shrink its trade deficit.
Makes sense on the surface.
And there's also the national security angle, the argument for using tariffs to shield strategically important industries, like manufacturing, from foreign competition, allowing them to develop and thrive at home.
But as we all know, the real world rarely sticks to the simple script. The review quickly pivots to the flip side, examining the significant challenges and risks that come bundled with tariffs.
Absolutely. One of the most immediate and tangible downsides is the potential for higher prices for everyday consumers. When tariffs are slapped on imported goods, those extra costs often get passed down the line, leading to inflation and, chipping away at people's buying power.
Yeah, you feel it at the checkout. And then there's the very real and often nasty specter of retaliation, right?
Oh, definitely. If one country starts imposing tariffs, the affected trading partners often fire back with their own tariffs. And before you know it, you're in the middle of a trade war, which can inflict serious damage on the global economy.
And not just the big economies, but everyone gets caught in the crossfire.
Curiously. Moreover, in today's interconnected world, many industries rely on incredibly intricate global supply chains, sourcing raw materials and components from all over. Tariffs can throw a wrench in these systems, making production more expensive and less efficient for domestic manufacturers who depend on those imported inputs.
It's like trying to bake a cake, but suddenly you can't get flour from your usual supplier.
Exactly, and finding a new one takes ages and costs a lot more.
Right. The review also touches on the recent wave of tariff usage, like the Trump administration's reciprocal strategy we discussed earlier, and underscores that there's a really lively debate still raging about just how effective these measures truly are.
Which perfectly sets the stage for us to delve into some real-world examples. The InfoDrip review pulls out several compelling historical cases where tariffs didn't quite live up to the hype and, in many instances, led to some pretty significant unintended consequences.
Right. Let's kick off with a big one, almost a cautionary tale. The Smoot-Hawley Tariff Act in the U.S. way back in 1930. This is practically legendary for how spectacularly it backfired, wasn't it?
It certainly was. In a bid to shield American industries during the teeth of the Great Depression, this act hiked up tariffs on a staggering range of over 20,000 imported goods.
20,000.
Yeah. But the reaction from other countries was swift and brutal. They retaliated with their own tariffs on American exports, triggering a sharp nosedive in international trade and actually making the global economic crisis even worse. It's almost unbelievable how badly that backfired.
Fast forward almost a century, and the review shines a light on the Trump administration's tariffs on China between 2018 and 2020. The underlying goal was similar to shrink the trade deficit and bolster American manufacturing, but what actually played out?
Well, as the review highlights, those tariffs translated to higher costs for American businesses that relied on Chinese imports, and ultimately those costs trickled down to American consumers.
So we paid for them.
Pretty much. And just like in the 1930s, China didn't just stand by. They hit back with their own tariffs, which had a significant impact on American agricultural exports. Farmers really felt that.
Yeah, I remember that. The review also brings in a more recent example from 2025, looking at Vietnam's experience with U.S. tariffs. Interestingly, they actually tried to negotiate their way out of higher tariffs by lowering their own on American goods and buying more from the U.S.
Right, a diplomatic approach. But what's particularly striking about this case is that despite those efforts at diplomacy and increased trade, the U.S. still ended up slapping a significant 46% tariff on Vietnamese exports.
Ouch.
Yeah. This had a considerable knock-on effect on Vietnam's economy, which is heavily reliant on international trade.
And going back a bit further, the review casts its gaze on Japan's protectionist policies in the 1980s. They used tariffs and what we'd call industrial policies, which involve government support and targeted investments in specific sectors to shield their domestic industries, particularly in areas like electronics and automobiles.
And while those policies did achieve some initial success in helping those industries grow, the review points out that over time, they also fostered inefficiencies and a slowdown in innovation in certain sectors.
Kind of got complacent.
You could say that. Eventually, Japan had to pivot towards more open trade policies to regain its competitive edge.
So the overarching lesson from all these historical examples seems pretty clear. While tariffs are often intended to be a shield for domestic industries, they come with a significant risk of ricocheting, driving up costs for consumers and businesses, triggering damaging retaliatory measures, and ultimately disrupting the delicate balance of global trade.
Yeah, it's rarely a simple fix. Given these inherent risks and the often mixed results we see with tariffs, the InfoDrip review then pivots to a more proactive and forward-thinking strategy that many nations are now exploring in response to these trade headwinds: market diversification.
This feels like a really key point. Instead of just playing defense against tariffs, countries are actively trying to lessen their dependence on any single trading partner. Smart.
Exactly. The review breaks down 5 key ways countries are putting this trade diversification strategy into action. The first is by strengthening regional trade agreements. Think of the European Union, where strong trade ties among member countries help to buffer them from economic jolts from outside.
Right, safety in numbers.
And in Africa, the African Continental Free Trade Area, or AFCFTA, aims to significantly boost trade within the continent itself, reducing reliance on more traditional Western economies. This proactive diversification isn't just about finding new markets, it's about building resilience against political and economic shocks from any single major partner.
Okay. The second tactic is expanding trade deals with emerging markets.
Yep. The review notes how China, for instance, has been actively forging stronger economic links with Southeast Asia and Africa, potentially as a way to cushion the blow from U.S. tariffs. And we're also seeing Latin American powerhouses like Brazil and Argentina increasing their exports to rapidly growing markets like China and India as alternative destinations to the U.S.
Finding new customers.
The third strategy involves actively encouraging domestic industries to adapt and explore new horizons. Governments are often rolling out incentives for businesses to look beyond their traditional export markets.
How so?
Well, this can include pouring investment into trade infrastructure, offering tax breaks for companies that diversify their export destinations, and working to improve overall production efficiency so they can compete effectively on a global stage.
Got it. Fourth on the list is the push to boost bilateral trade with countries that weren't traditional partners.
Right. The review gives the example of Vietnam, which, after facing those U.S. tariffs, made a concerted effort to ramp up its exports to the European Union and Japan.
Smart move.
We're also observing increased economic cooperation between Russia and China as a response to Western sanctions and trade barriers. Kind of a geopolitical shift there, too.
Definitely. And the fifth crucial way nations are diversifying is by developing digital trade and e-commerce.
Yeah, this is huge. It allows businesses to tap into new markets across the globe without the same reliance on physical shipments and the tariffs that can come with them. By focusing on services and technology, they can reduce their vulnerability to traditional trade barriers.
So the overarching aim here seems to be to build long-term economic stability and reduce a country's vulnerability to policy shifts or economic downturns in any single major market. It's about not having all your eggs in one basket.
Absolutely. And to really bring this to life for you, the InfoDrip review offers some concrete case studies of countries that have successfully navigated trade diversification strategies.
Oh, good. Let's start with Costa Rica. The review highlights their efforts beginning around 2009, after they ratified the U.S. Central American Free Trade Agreement, or CAFTA-DR.
What's particularly insightful about Costa Rica is that they didn't just rest on the laurels of that agreement. They actively worked to deepen their economic ties with the European Union and China, particularly in thriving sectors like technology, medical devices, and agricultural exports.
So they used the U.S. deal as a springboard, not an endpoint.
Exactly. Their joining the OECD in 2021 further cemented their position in the global trade landscape.
Then there's Vietnam, a country we touched on earlier. Their diversification journey really took off with the OMA economic reforms way back in 1986, which opened up their economy to the world.
Right. And since then, Vietnam has strategically cultivated stronger trade relationships with key players like Japan, South Korea, and the EU, gradually lessening their dependence on the U.S. market.
That EU deal must have been big.
Oh, yeah. The EU-Vietnam Free Trade Agreement, which came into effect in 2020, was a significant milestone, enabling them to boost exports in sectors like textiles, electronics, and agriculture.
India is another compelling example, with their shift from a more protectionist economic model to a liberalized trade approach starting in 1991.
And over the years, India has actively pursued diversification, expanding its partnerships within Asia and Africa. Their involvement in the Regional Comprehensive Economic Partnership, or RCEP, has been instrumental in strengthening trade ties within Southeast Asia. By 2024, the review points to a notable surge in India's exports, reflecting their growing global trade footprint.
Moving to Africa, the review spotlights Gabon's efforts starting around 2018 to reduce their reliance on oil exports, which had traditionally been the backbone of their economy.
Yeah, that's a classic resource curse problem they're trying to tackle. Gabon has been strategically focusing on developing other sectors like agriculture, mining, and timber. Interestingly, China has emerged as their largest trade partner during this period, and they've also strengthened economic links with countries like Indonesia and Spain, helping to buffer their economy against the volatility of oil prices.
Finally, there's Senegal. It began actively diversifying its trade around 2014.
Senegal has been increasingly exporting goods like fish, textiles, and agricultural products to both Europe and China. Their participation in the African Continental Free Trade Area is also unlocking new trade opportunities within the continent, and they've been leveraging trade agreements to attract vital foreign investment.
So across all these diverse case studies, the common thread that emerges is a strategic and proactive approach to building economic resilience by looking beyond traditional trading partners and sectors. Makes a lot of sense.
Now, the InfoDrip review takes an interesting turn by examining the perspective offered by Kenya's Ministry of Trade regarding this new U.S. tariff policy.
Yes, their press release seemed to paint the tariffs as more of a window of opportunity for Kenya, highlighting their relatively lower existing 10% tariff compared to some other nations. A bit optimistic, perhaps.
Well, while that optimistic spin might sound appealing at first glance, the InfoDrip review raises some really crucial counterpoints and flags several significant concerns that might have been overlooked.
Okay, let's unpack those points of potentially misplaced optimism. The first one the review tackles is the idea of Kenya gaining increased competitiveness in the textile sector.
Right. The Kenyan Ministry of Trade suggested that their lower 10% tariff would make them a more attractive option for U.S. buyers. However, as the InfoDrip review rightly emphasizes, shifts in trade aren't solely determined by tariff rates.
Yeah, there's more to it.
Exactly. Factors like the efficiency of the entire supply chain, getting raw materials in, manufacturing quickly and affordably, and then distributing the finished goods along with overall production capacity and infrastructure play a massive role.
Things Kenya might struggle with.
Potentially. Countries like Vietnam, Sri Lanka, and Bangladesh have spent years building these intricate systems, giving them a significant edge that Kenya currently doesn't match, even if their tariffs are higher. So a lower tariff alone doesn't guarantee a big surge in U.S. textile sourcing from Kenya.
Okay, that's a dose of reality. The second point of concern is the potential for retaliatory effects down the line.
Even if Kenya might be spared from the initial major tariff hikes, the review underscores that the U.S. policy reflects a broader leaning towards protectionism.
Meaning things could change quickly.
Exactly. That means there's a very real risk that U.S. trade policies could shift again in the future, potentially leading to tariff increases for Kenya down the road. The review points out that the Kenyan press release doesn't really address this inherent volatility and seems to assume a level of stability that might not actually exist.
So counting chickens before they hatch.
A bit like that. Kenya needs to be prepared for potential future tariff hikes, not just celebrate the current landscape.
The review also flags a potential oversight regarding Kenya's existing trade deficit with the U.S.
Yeah, this is important. Kenya already imports more goods from the U.S. than it exports. So while tariff changes might influence the cost of those imports, they might not do much to actually improve the overall trade balance without addressing more fundamental issues like scaling up production efficiently,
Right.
which involves tackling challenges like labor costs and logistics. Just changing the tariff math doesn't fix the underlying production gap.
Another critical point raised is the limited discussion in the Kenyan response about the vital need for export diversification.
Yeah, this connects back to our earlier point. The review stresses that while Kenya seems to be focusing on trying to gain an edge within the U.S. market, Other nations facing similar challenges, like Vietnam, India, and Senegal, have been actively working to broaden their export destinations.
Looking beyond the U.S.
Precisely. Kenya, the review suggests, would be wise to strengthen its ties with other markets like the EU and explore the growing intra-African trade opportunities offered by AfCFTA rather than putting all its eggs in the U.S. basket.
Finally, the InfoDrip review questions whether the Kenyan government is truly grasping the cost burden that even a seemingly lower 10% tariff can impose on their exporters.
Right. Even though 10% might be less than what some competitors face, it still adds to the overall costs for Kenyan exporters, particularly in industries with tight profit margins like textiles.
Every little bit hurts.
It does. The review notes that while the government mentions commitments to improving infrastructure and developing skills, the press release lacks concrete policy specifics, such as targeted subsidies, tax incentives, or investment partnerships that could actually help Kenyan exporters seize this perceived opportunity. It's easy to say it's an opportunity, harder to make it one.
So, to bring it all together, what are the key takeaways for you, the listener, from this deep dive into the intricacies of tariffs and global trade?
Well, we've seen how an unconventional approach to calculating tariffs, like the one we discussed at the outset, can really oversimplify a complex economic landscape. Not always helpful.
Definitely not.
We've also explored the multifaceted nature of trade deficits, not always bad, sometimes a sign of strength, and the often risky proposition of using tariffs as a one-size-fits-all solution, highlighting historical examples where they've actually backfired. Smoot-Hawley being the prime example.
Yeah, big lesson there.
Yeah.
And importantly, we've examined the proactive and increasingly vital strategy of trade diversification that many nations are now embracing to build economic resilience in the face of evolving global trade policies. With some really insightful case studies illustrating how this is being successfully implemented by countries like Costa Rica, Vietnam, India.
Right. Showing it can be done. Finally, we've taken a closer look at a specific reaction to new tariffs, in this case from Kenya, and underscored the importance of looking beyond initial optimism to consider the underlying economic realities and potential hidden challenges. Don't just take the press release at face value.
Absolutely. Yeah. So as you digest these global shifts and the diverse ways nations are responding to trade policies, here's something to think about. What do you think is the most critical element for a country to secure its economic future in our increasingly interconnected world? Is it primarily about protection through tariffs, proactively adapting and diversifying trade relationships, or perhaps forging entirely new paths through innovation and technological advancement?
Or maybe a combination of all three.
Maybe. It's certainly a lot to consider. Food for thought.